In any case, I'm glad that you're here for our inaugural session of Straddles and Strangles. I am joined in the chat by Brent Morse. So glad Brent's here. He's a veteran of the markets. He's been trading these strategies for years. And if you have questions, go ahead, let us know. It's not something that we have really stressed a lot, these particular strategies in the past. So we're going to have some fun with it. And I appreciate your feedback. You're hearing me now. Excellent. We like that. Let's go through our disclosures and get on with our agenda. We have a lot to cover here today. Options carry a high level of risk and are not suitable for all investors. With long options, investors may lose 100% of their funds invested. We will be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim. It has lots of nice features for option traders. As you use the Paper Money, practice in it, okay, so that you get familiar with how to do the kind of trading you like to do and different strategies. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results or success. All right. Typically, we're going to take a look at what's going on in the market. You guys probably know, but we'll just take a quick gander at it. And then I want to talk a little bit about the construction of a straddle or a strangle, what they are. And then I want to do some examples, and I'm going to walk you through kind of step by step how you might go through this process. All right, so let's hop over to Thinkorswim. And let's just bring up our SPX, if my keyboard will work. There we go. All right, have the SPX up here. We were up earlier, and it looks like maybe we still are up. Looked like the markets had faded a little bit from where they were, but maybe they're just kind of getting back there. Another all-time high in the SPX on Friday. It's kind of like a broken record, right? It's repeats. NDX was very similar in terms of forming a new high. It looks like it's formed a new high here today, and it's holding on to its gains, so it's still positive on the day. And the Dow Jones, take a look at the Gorilla, new high on Friday as well. Not today, but definitely some decent movement today. Looks like currently it's down a little bit. So I'm going to say it's a little bit on the flat side of things. And then, of course, our volatility index. It's been in lower areas. So we haven't seen a lot of volatility. We've seen some little kind of, let me zoom in here, some little kind of peaks, right, where it'll run up. You can see I've got it in this kind of this channel down here, although it's starting to maybe create a little bit more of an upwards channel here, but still in these really low numbers, right? We start feeling it when it pops up to 19, 20, things like that and beyond. Then we really start feeling it. We start seeing a lot of red all over the place. But right now it's in a pretty relatively calm area. Okay, now let's talk about straddles and strangles for a little bit. I'm going to bring up a blank sheet of paper, or a blank document, I should say. So we'll suppose it's a sheet of paper that I can write on, right? And I want to talk through a little bit about construction of a long straddle or a long strangle. So first of all, a long straddle is when you buy a call and a put of the very same strike price that's at the money, okay? A strangle is a little bit out of the money. So instead of, we would buy a call out of the money and a put out of the money. We'll be looking at both of those and kind of what the difference is and how you might decide, should I do a straddle or should I do a strangle? Okay, and I'm just going to ask you here, how many of you have traded this strategy before? I want you to chat into me. If this is a strategy you have explored or paper traded or done before. I know sometimes we'll talk about it in our selecting an option strategy class when we get around earnings as a potential strategy. But I'll let you send your feedback in. So let's talk about what you might consider. Okay. One is we need these stocks to move a lot. Okay. Greg's a once or twice. Kelly has done the short straddles. Okay, so a little bit, a never, both a few times. Okay, we kind of have a mix here, but it doesn't look like it's a strategy you use all the time. Plus, sometimes around an FOMC announcement, that can be a time. This is a strategy where you're like, I'm expecting a big move. I don't know which way the big move is going to go. It could go long, it could go short. So you want to have your bases covered, but you're expecting a good size move. Abhijit says you learned about it on the online course, but haven't traded it. That's all right. Very good. R1 is you paper traded a Microsoft one over earnings. I'm glad that you're at least familiar with it, most of you. Okay, and yeah, there's some of you this is brand new to you. That's just fine. Okay, so first consideration is we want the stock to have a big move. Okay, and so we're going to look at history. Let's put big historical moves. And we're going to maybe look at the last year. You can look at a couple of years, but just getting an idea, what is the stock doing recently? Does it move big? Does it not move big? We're going to be looking at some earnings dates today. Okay, so big historical moves. Liquid options, okay, maybe that goes without saying, but we need liquidity. And in this case, we're using two legs. We need both of them to be liquid. So if they can be weeklies, that's nice. It doesn't guarantee that we'll have liquidity in them, but usually stocks that do have weeklies have a lot more trading activity with them, generally speaking. And so that can be a direction we can look for. Now, as we go into an earnings season, what happens with implied volatility? It has a tendency to run up, doesn't it, as we go into earnings? So if we're considering this strategy and we're like, oh, XYZ is announcing tomorrow, some people might get into a trade at that time, but you have to understand the implied volatility is going to be really high. What does that mean? It means your options are going to be really expensive. And so if you can kind of plan ahead a little bit, maybe there's particular stocks you like to trade over earnings, then you might consider, when do they announce and get in before then. So some examples we're going to look at today do not have earnings until a couple of weeks from now, okay? Which it can be advantageous because with a long call and a long put, if implied volatility goes up, all things being equal, what should happen? Well, the price of those options should go up. That would be beneficial to us as a trader. So we're gonna use it a couple of weeks out, but no, you don't have to, but that's a limitation you might have. And then another consideration here is going to be the stock price. Why is stock price a consideration? Because some of these stocks are really expensive and the cost of their option contracts might not fit your position sizing and the size of your account, okay? We'll look at an example of that. But these are some things to just keep in mind as we walk through this process. So take whatever notes you need, and I'm going to move this off our screen. Okay. One stock we know, I shouldn't say we know, but historically that has had big moves over earnings is Netflix. They have earnings in the time frame we're looking for right now, but look at the price of their stock, $1,151. There might be a few of you that might feel comfortable trading a stock in that price range. There might be a few of you, after you look at the price of the options, you're like, holy cow, not this strategy. And that very well may be the case, okay? This $1,150 stock, let's see, a call premium is going to run us about $55. And the put here is going to run us about $50 and some change. So we have to add those couple of zeros on to the end of that. Those are really expensive contracts. Not everybody has $10,000 to put into just a single trade with one options contract. Okay, so kind of bear that in mind. If you're like, oh, get all excited about somebody coming up that typically moves, might not fit in how you should trade your portfolio. All right, the ones that we're going to use for options today, I've tried to have them be a little bit more reasonably priced. So let's take a look at a couple of things. One, how do you know what stocks are going to be announcing in advance? Well, I'll show you what I did. I went over to the Market Watch tab. I came over to the calendar. I put in earnings. That's the only event I wanted to see here. And then I moved up my calendar. Okay, so our calendar, or today is October 6th. So we've got earnings this week, then October 13th, and then October 20th. Okay, so I went out these 2 weeks in advance. This is saying the 19th on Sunday, because sometimes there might be some that announce on Sunday, but not generally speaking. So as you come into the earnings calendar, you're going to be able to see, it might be a little hard to see on my screen right here, but like this little one right here on Monday, it says we've got 8, and it's right here at 7 o'clock, which means basically pre-market or earlier in the day. And then and that's typically when companies announce, right? Either before the market opens or after the market closes. And so there are some additional ones here Monday night. It looks like there's about 18, but I went fishing where there would be a lot of companies, okay, that maybe might be recognizable. So I kind of looked in Tuesday, and some that I picked, most of them I picked, I think, came from Wednesday and Thursday, okay? And so if you click on that calendar date, it will populate down below. You can see the date changed here to October 22nd. And there may be a situation, or I should say this, you might develop your own watch list specifically for this strategy, okay? That you're like, yep, every time they have earnings, yep, I want to play them. Yeah, you're comfortable, familiar with them. They meet all that criteria that we just talked about. We don't have a fixed watch list right yet. So I went ahead and just kind of picked through who has earnings and looking for the big names that you'll recognize, because those are going to be the ones that have the liquidity. They're the ones that maybe will have weekly options as well. So maybe something on the Dow, something on the S&P 100, the NASDAQ 100, maybe S&P 500. I'll open it up a little bit more broadly. Okay. So those are the kind of names that we want to mostly be looking for. Small caps, there could be some small caps in there sometimes, but a lot of the ones that have the liquidity are going to be those larger cap stocks. Okay, so I am having a little bit of bias towards them. Well, let's take a look at our first example. We're not going to use Netflix. Okay, the first one we're going to take a look at here is IBM. I worked for IBM for a very short period of time in my youth. And I had to laugh because the guys I worked with, they said, yeah, IBM stands for I've been moved. I guess there were always transfers at IBM. So let's look at the last year, because we want to know, does it look like this stock makes big moves over earnings, or it could be another announcement, okay? And so what are we going to look for? We're going to look for gaps, and we're going to look for big candles, okay? And we're going to just look over the last year. So I'll show you what I did here. I'm going to zoom in on this furthest left one that looks like it was maybe in October. And we can line up and see when the earnings day was. Looks like this was after the market closed on the 23rd of October. Is that a big move? Yeah, when we see these gaps in the chart, that gives us an indication there are some big moves, okay? I won't drag you through the whole process that I did, but basically I went through each of these earnings and I said, what was the closing price on the day before they announced, and what was the closing price after? Okay, so here on IBM, this move was about $16.59. That's not a bad size move, right, for $200 stock. And then we're going to kind of move down the calendar here a little bit. And let's get into January. So here's the January move. Closed here at 228 and change. Next day, closed at 258. So pretty good size move here. That one measured, that was the biggest move they had actually, was 29.64 in that January earnings. Okay, next up, we're going to move ourselves down to the April earnings. Big gap, big movement. Okay, so same thing. I took the closing price to the closing price. Although I should say that it doesn't mean that's the only period of time you might trade. Okay, but we're just kind of getting an idea, does this thing move or not? This move was about $16.15. And then the most recent earnings, big gap down. Okay, closing price here, 282.01, closing price here, 260, so about 20 points, almost 21 points on this move. Now, I'm not excluding the extreme of the day where the lowest price went to, although that could make it end up being a bigger range. Many times with these trades, we're just looking to play the initial movement. It doesn't mean it couldn't continue to go, because it certainly could. We've seen that happen. But we're trying to get an idea here about how big does the stock move. So I took the average of those 4 moves over the course of the year. And I kind of told you what they were. Actually, the last move was about $21.50, and the average of all the moves was $20.97. So about 21 bucks. Well, for a $200+ stock, if it were only 200, that'd be about a 10% move. So it's going to be a little bit less than a 10% move, but certainly a decent move. Okay. Let's see. Greg says, Connie, in the future, we could build a scan to find the liquidity and gaps around earnings. I'm going to work on that, Greg. That's actually been one of my thoughts. I would think it would be nice to have a watch list. I haven't curated one, and I'll show you through the process. Leslie Kelly worked at IBM for a little bit too. Deegan was in Rochester at that time being a programmer. You guys know all about IBM. IBM also stands for something, but it would be rude to type it. Ooh, John, I don't know what that is, but we're not going to even guess. Okay, so I'm going to say, yeah, essentially it moves big. Next step, we're going to go to the option chain. So here we go to the trade tab. And I'm going to collapse this for a minute. Generally, although not always, but generally in the week that, if they have weeklies, that a stock is going to announce their earnings, generally that week, the implied volatility that we see priced in here can be a little bit inflated, especially the closer we get to the earnings announcement date. We're out a ways in time. We're a couple of weeks removed from when they're going to announce. And so right now, it's not quite as inflated. All right, so I told you the week we were looking at was October, starting on Monday, October 20th through the end of the week. So the options that we would trade would expire on the 24th. And I should show you here, let me back up. The exact day they're going to announce is going to be the 22nd. So that's going to be on Wednesday after the market closes. Okay, so then you know, okay, that's the target as far as where the implied volatility is going to be baked in. So it's going to be in these October 24s. It's not that big. I mean, it is a little bit bigger right now, 45% compared to 30%. So it is about 15% higher. As we get closer into earnings, we might expect that to ramp up though, okay? Which would be beneficial for a straddle or a strangle for a long option. Now, today they opened up some new contracts that weren't there on Friday, okay? So we can see when we look at the strike price increments, they've added some that are $2.50 away, all right? So 290 had been here. There's some open interest there. 287.50, brand new today. And you can see every other strike price that has that 50-cent increment in it, those are all zeros. Now that may cause some of you concern because you're like, well, they don't have open interest now. Are they going to have it? And we don't know for sure if those strike prices will have open interest. But we can maybe go along with the assumption they created them because they think there's going to be some demand for them. All right, how much of that demand, we don't know. But what's the at the money strike price here? We're going to focus on the straddle today. 290.25 is our strike price. So that's kind of nice. It aligns with the 290 where we do have a little bit of open interest already. Okay. So we're going to take the premium for the call side, which is 1190. I'm going to clear out my calculator here. So we've got the call side is 1190 and the 280 put is $11 even. $22.90. I'm just going to write this number down here. That's a chunk of change to have you put into a trade, isn't it? And so you want to, so one thing you might look at and consider is, okay, does the average move, is it sort of up to what's priced into that straddle? If it is, then you might feel a little bit more comfortable. If it's quite a bit different. For example, say the average move on this one was $5 instead of $21. If it were $5 and the premium for the straddle was $29, you might be a little concerned. You're like, oh, historically, it hasn't moved that much, right? Because as soon as the announcement's out, what happens with implied volatility? Crushes, right? It comes crushing out of these options. That means the prices go down for that time element. The intrinsic value stays there, but because they're both at the money options, they don't have usually a ton of intrinsic value. One side might, call might, put might not, or vice versa. But both of them are going to have a ton of price timed in there, and that just comes crushing out with that vol crush. So that's why you might look at, what is that straddle going to cost, and has it moved about that amount? And so I'm going to say, yeah, that's pretty close. It's been moving in the 20s. And so we might think, okay, this might be a reasonable one to do and to consider. All right. So what we're going to do is we're just going to, I'm going to hold down my control key as I click on the ask price on that call. And I'm going to hold it down, and I'm going to do the ask price on the put. So there we go. There's our 22 and change, okay, for this option. Now, when we think about, what is the likelihood of this trade working the way we need it to, we need the one side or the other to expire in the money. Can they both expire in the money? They really can't, can they, right? Yeah, typically what we're going to find is one could expire in the money and the other one out of the money. And so when the announcement is made and we know what direction the stock is initially going to move, we don't know if it's going to stay there, but sometimes we might take action on it and close out one side. So if the news is good and it really pops and the puts or the call is looking pretty good, then we might decide to go and just kind of salvage what we can out of the price of the put with the expectation that it's going to continue to run up. However, I have seen situations where it gaps up and then it falls the rest of the day, and it ends up closing closer to being profitable for the put. Okay, so these can be a little bit tricky to manage. All right, let's see what it looks like here real quickly on the Analyze tab. All right, so go over here to the Analyze tab. Let's delete that. I'm going to have it hide any positions in IBM that we have, which I don't have any. I'm going to kind of look at what the risk profile looks like here. A big old smiley face. I hope it's a smiley face when we're done with it. Okay. But basically, you can see the extreme moves. This is our 0 line. Anything above 0 means that we're making something above the break-even point, right? And if I set the slices to the break-even point here, what are we going to see? We're going to see, this looks like 312 and change or 267 and change. So that's why we're saying we've got to see it make a big move so that it moves into the profit and loss beyond that point. Okay, right now, the two price slices, there's a 36.8% chance that the stock is going to expire between our two price slices, which are our break-even points. Okay, so that's 36%. So the remaining of that is that it would expire hopefully above that area or below that area. And we don't care which one it is. We just want one of them to move pretty good. Okay, but this is kind of what you want to walk through to have a realistic expectation of what's the likelihood that the stock's going to end up in here. What's the likelihood that it could extend beyond there? So if we add 33 to our 30, then we've got more of like what, a 63% chance of it going beyond our break-even points, one way or the other. All right, let's get rid of that. We're going to go ahead. We are going to put in this one. We're just going to do get rid of my yellow here. We're just going to do a right mouse click on it. We're going to hit confirm and send from here. You don't have to. We could have done it from the trade tab, but It doesn't have a grouping yet. I'm going to go ahead. We're going to send this in. I am going to unclick just in case it got a little bit cheaper for us. Oh, let me edit. Let's see if it got a little cheaper. It's up a little bit. It's pretty close to the same price. Let's go ahead and send it in, confirm and send, and then I'm going to put it in its own grouping. Now, managing the trade, our expectation is we're not going to do a whole lot until earnings gets close. We'll watch it. We'll see what's going on. What if implied volatility really ramps up on this over the next 2+ weeks? Well, we might be sitting in a position, I've seen this happen before, where maybe you're like, I'm up 40% on this trade already. We haven't even had earnings yet. I'm already up 40%. Some traders might decide to not even trade it through earnings. They're like, hey, I got the implied volatility move. They might be happy with it. And it could be that you're profitable actually on both the call and the put, as strange as that seems, just because of implied volatility. Okay, but suppose it just kind of ramps up a little bit and it's not anything really extreme, then the plan will be, let's hold it over earnings. Let's look for a big move. Let's see what direction it goes, and let's continue to play it out. Okay, so I expect when we meet back here again next week, we're still going to be in IBM. We're still going to be waiting for their earnings to occur. Yeah, Brent's saying, the long straddle and strangles, those long options, when implied volatility goes up, that increases the premium. So we just paid $22.70, $22.80 or something like that for it. We just got filled. And so the expectation is that as implied volatility increases, that the premium would. In fact, we could put a study on here. I wasn't planning to bring this up, but let's go ahead and bring on the implied volatility. Let's make it a little bit thicker here so we can see it. And if we kind of go out historically here, can we see implied volatility ramp up and then drop at the announcement? Yeah, we look at it clear over here on the left. It was a little bit flat, but man, did that drop. Okay, going into the next earnings before that, looks like it was ramped up a little bit, maybe pulled back a little in the implied volatility before the earnings announcement. And then on the big gap up, implied volatility drops. That's what we're talking about with that implied volatility crush, that it just comes out of the option. I'm going to say a lot of it that very first day. It can continue for a few more days, but the biggest amount typically is right after the announcement. And so we see the implied volatility run up here and pull back, and then the huge slam here. And then the most recent one, it was low here. This is in June. And so during the month of June, and as it got into July, that's when it ramped up quite a bit here. So that's why I'm saying maybe look, at least some of the examples we're going to look at today, we're looking 2 to 3 weeks out to see if we can see this movement here as well, because then maybe we're like happy campers and like ready to get out. Let's see here. So our one says, what time period should one enter a straddle before earnings? Could it be the day before? Yeah, so what I mentioned, it could be the day before because maybe you weren't aware of it and you were like, oh, I want to trade it. But what you need to realize is that the options are going to be likely more expensive because of that implied volatility ramp up. Those options could be a little bit more expensive right before options expiration date. Okay, we'll do a number. We'll do it various ways. Today we're starting with looking a little bit out, being a little bit proactive and saying, hey, let's look for things that have been moving over earnings. Let's go prove it out, see if this might be a good strategy for it. Okay. All right. Yeah, Brent's helping out here answering some of these questions. Appreciate that, Brent. All right. John says, how about LVS sideways earnings on October 22nd, Las Vegas Sands? That typically has been a big mover. So you could do the same thing with Las Vegas Sands that we just did with IBM. Go back historically, see if they have big moves. We're not going to use it as an example because I hadn't planned on it and I hadn't done my homework on it yet. So, you would want to go ahead and do your homework on it. Let's look at another one here. Texas Instruments, TXN. Has it been a mover over earnings? it's not quite as obvious with this one as it was with IBM. With IBM, we're seeing some really big gaps. Okay, but let's see what we have on TXM. I'm going to zoom in here on the left, looking at that first earnings. So there was a little bit of a gap up here, wasn't there? So it closed here, or I should say it closed at 193.97, closed the next day at 201.74. So that move was about $7.77, which is not huge for a $200 stock. Okay, let's look at the next one. So that was in October. Let's move ourselves along to January. And here's the January earnings. Closed here at 197, closed the next day at 200. So a 7, let's see, that one was about, let's see here, 197.05, and it closed at 200. So in the neighborhood of about $7. Is that right? 197 to, oh, $3, about $3. So not a huge move there. Next move, on our way, here we go. Here's the April earnings. Closed here at 152, closed the next day at 162. And you can see afterwards, it didn't continue to move, which is something you'd kind of want to know that, you know, usually it just kind of moves that first day and then it settles down. So that one, 162 is where it closed, 152. So that one was about $9.98. So it was about $10. All right. This last move was actually more significant. Let's kind of move ourselves out here to July. So the last time they announced, it closed here at 214.92. So let's call it $215. Closed the next day here at 186. So that move was about 28 points. This was a 28-point move. It was really big. So bigger actually than the previous three. That raised their average. So the average move here is about $15. $15.38 is what it averaged over these 4 moves. Okay, let's go look at the premiums here. One thing I did want to mention here, that we can see the implied volatility is up here. We can also see that we don't have the market maker move in here yet, and that was true in IBM. This little area right here, some of you might be familiar with it, some of you might not. This is, it's called the market maker move, and this little icon technically is 2 M's on top of another M, okay? To me, it looks like barbells, but it's MM, stands for the market maker move, which tells us what is being priced into the at-the-money options for the event. These aren't priced in yet, okay? Because we would see bigger numbers because of that. All right, so let's go ahead. Let's look at the October options here. We're going to look at the 24s because they announce on the, I didn't show you this, but I will now. They are due to announce on the 21st. So most of the examples are the 21st or the 22nd of October, okay? So we do, again, we're 2.5 weeks in front of this. Now, as we go over to the trade tab, we can know, well, what do the market makers think? What do they think is going to be the movement based on those at-the-money strike prices? Okay, and so really, stock right now is at 182.18. So this new 182.50 strike price, that was just, again, another, hasn't been around all that long. It looks like 0. We're seeing lots of zeros here for those new increments in the strike prices that they just added. Okay, but we're just going to take the premium here, 750. Let's grab our calculator back here. 7.5. I know that just changed. Plus the put premium of 7.45 is essentially what the market maker is being priced, what's being priced into those at-the-money options, which means the expectation of movement, they're saying, is about $18 right now. So that one, I think, it is a little bit bigger than our average, but remember the last move was really big. And so maybe things with this particular stock, semiconductors, things that are going on in the tech technology sector. There's so much going on there right now. Maybe they're expecting a little bit bigger move than maybe what they had a year ago or 6 months ago. Okay, so that can kind of give us this idea. When we get closer to the earnings date, this market maker move number, more likely than not, is going to run up. Not all stocks have the market maker move, okay, but some of them do. And that's actually what I have on my chart as well. That's something that I'll share with you. These little dotted lines are pricing in the market maker move as it is right now. So again, I expect it to get wider in the range of what we just calculated there. I think that was almost 16 bucks as far as what the expected move was. So you can see up here where it says market maker move right now is 1.91. Okay, so that's not for the earnings yet. If you would like to see this on your screen, I'm going to share this with you. Anytime we share a script, remember, it's not guaranteed as to accuracy or timing. But some of these little scripts can be really helpful. Okay, so Texas Instruments. Let's go ahead and let's put in our straddle here. Let's see if it, I guess it didn't really save it. Let's go ahead. I'm going to select. Now you're going to be concerned. Should we be concerned that there's no open interest here right now? If you are concerned that there's no open interest here, what you might decide to do is the strangle, which goes out of the money. And so we'd say, okay, maybe we'd go out of the money with the 185 and then out of the money on the put side at the 180, where we can see there is quite a bit of open interest. Okay, so if you find yourself in that situation, that's what you could do. Because I wanted both of these trades to be the same today, I'm going to go ahead with the straddle, but I could understand why you might decide to go, no, let's do the strangle. Let's make sure we've got that open interest there. But I'm going to hold down my control key. And then I'm going to come over here to the put side of things. I'm going to hold down the control key, get both of those in there. So about $14.60 is what's being priced into the move right now. Let's go ahead. We're going to send it off. We're going to hope to get filled on it. And again, my expectation is we're going to be in this trade when we come back here on Monday and look at things. We're going to be in both of these straddle trades, and we'll see what's happened with the implied volatility if they've run up. We'll also look at some new examples for further out than what we were just looking for right now. All right, I want to come over here to the chat, see if there's any questions I still need to answer. I know Brent's been busy answering a lot of questions. Would I recommend the videos a year backwards on this channel? Would they be insightful in terms of understanding which correlates with what in terms of options? Some of them are going to be very valuable and useful to you, Jonathan. Even though they took place a long time ago and the price of the option changed, I would say especially in the Getting Started with Options series, Cameron May does a great job with that. I think it's on Monday or Wednesdays. And he'll teach these basic strategies, long calls and long puts, which we're doing here today. He'll go through each of those a week at a time. And so that information, yeah, that's definitely going to be valuable to you. Okay. There might be some that are based on market conditions and the market conditions are done, but you can still learn from it. Still could be really beneficial for you. Could you explain the earnings sub-tab under the analysis tab? We do not, my time is almost up and we're not going to have time to get into that, Harry, but I'm going to make a note of it. Maybe that's something we could touch on sometime during the week or maybe next Monday. Okay. How do I have access to option chains not shown, the weeklies? Jonathan, it could have something to do with your setup if you're not seeing weekly options. Okay, we'll go to answer this one question, but I need to touch on something else. Over here, you have some filters, and my filters are off. But if you click on filters, you can say, don't show me weeklies. Okay, so which expiration types? I've set all of them. But if yours are only set to regular or whatever, here you could designate quarterlies or just weeklies. Okay, and I've got it selected so that we're just seeing all of them. Okay, that I want to see all of those regular. Oops, that kicked off, didn't it? Come back here. Yeah, back here. All right, we want all of them to show up. Okay, so that could be what could be happening to you. Now, I know most of you are subscribers to our Trader Talks channel. It's so beneficial when you do that. When you do, it makes it a lot easier to find our content. And I'm just going to switch over there, find my screen where I have my Trader Talks channel. And so we'll show you what's coming up. We're in our straddles and strangles right now, but coming up next is going to be Barb Armstrong at the top of the hour with trading a smaller account. She does such a great job with that particular class. And so you can see what's coming up. You can come into any of the playlists. So our playlist for this class will start growing with today's class. And then we have another one here that's called bite-sized content, which are just really little short videos for you to be able to learn something just in a little snippet. Usually these are less than 10 minutes. I did one recently here where I taught you last week how to build your grid charts, which are multiple charts in one view. And so it's just 5 minutes and 42 seconds. Okay, so I'm going to encourage you to check those out. I'm willing to bet Brent has one on here. Here we go. He posted one, looks like about a month ago. Are you getting the most out of your scans? And so you can go in, just learn from this little bite-sized piece of information, okay? I didn't see a survey out there today, but if this was helpful to you today, this material, go ahead and hit the like button. That'll let others know that you found it valuable and that they might find it useful as well. Brent and I would love for you to follow us on X as well as becoming a subscriber to our Trader Talks, so it makes it easier to find the content. I love that about YouTube. Man, I have different subscriptions to different podcasts. I love it. Helps them find the content so much easier. All right, I think we've answered all the questions. Thank you, Brent, for helping with those questions. Some of those open interest, John has a question. What's the open interest? That's that column that shows us the balance of contracts sitting out there right now. Those are the balance of contracts trading. We want to go where there's activity. We want to be using contracts where there is some open interest so that we know it's easy to get into and out of. Some new ones were just put on this morning in $2.50 increments on the two stocks we looked at. So some of those didn't have an open interest yet. I expect that to pick up as we go through the next couple of weeks. All right, you guys, appreciate you being here. No survey today, like I said. So take a little break. I would encourage if this is a strategy you want to learn, maybe paper trade along with me in your paper trading account. Do these example trades. That'll allow you to have questions come to your mind as you're looking at them during the week. And that helps you learn the strategy so much better than just sitting there watching me do it. All right, we'll see you at the top of the hour with getting started, or trading a smaller account rather. See you then. Bye-bye.